Hey everyone, it's Brian, and welcome back to my channel. Today, we're diving into the world of REITs, or real estate investment trusts. Managing properties can be a real headache. That's where REITs come in. They allow you to invest in real estate without the hassle. Think of REITs like buying tiny pieces of an apartment building. Earn passive income from rent payments. REITs can offer serious diversification to your portfolio. We'll explore top REITs for strong returns in 2024. Grab your notepad and let's dive into the world of REITs. Now, before we jump into the specifics, let's break down what REITs actually are. In essence, a REIT is a company that owns, operates, or finances income-producing real estate. Think shopping malls, office buildings, apartments, even cell towers. REITs cover it all. They generate income by collecting rent from tenants and then distribute a significant portion of those earnings to shareholders as dividends. This makes REITs particularly attractive for income-focused investors seeking a steady stream of passive income. REITs come in different flavors. You've got equity REITs, which own and operate properties, mortgage REITs that provide financing for real estate, and hybrid REITs that do a bit of both. Each type has its own risk and reward profile, so it's important to understand the differences. But here's the kicker. REITs are legally required to pay out at least 90% of their taxable income as dividends. This structure makes them a fantastic option for investors seeking consistent cash flow and potential for long-term capital appreciation. Now, you might be wondering why investors, especially those who are already into real estate, choose REITs. Well, the beauty of REITs lies in their simplicity and accessibility. Imagine buying a rental property. You'd need a hefty down payment, deal with tenants, handle repairs, and navigate the ever-changing real estate market. With REITs, you can skip all that. You can invest in a diversified portfolio of properties with just a few clicks, all while sitting at your computer. Plus, REITs offer a level of liquidity that's unmatched in traditional real estate. You can buy and sell REIT shares on stock exchanges just like any other stock, making it super easy to adjust your portfolio based on your financial goals. And let's not forget about the potential for capital appreciation. As the value of the underlying real estate assets held by a REIT increases, so does the value of your investment. It's a win-win situation. But here's the thing that gets me really excited about REITs: their potential for both consistent dividends and capital appreciation. It's like having your cake and eating it too. Remember, REITs are legally obligated to distribute most of their taxable income as dividends. This means you're essentially receiving a share of the rental income generated by the properties held by the REIT. It's like having a steady stream of passive income flowing into your account. But it doesn't stop there. As the economy grows and demand for real estate increases, so does the value of the properties owned by REITs. This translates into capital appreciation for investors, boosting your overall returns. And the best part? REIT dividends are often taxed at a lower rate than ordinary income. This tax advantage can significantly amplify your after-tax returns, making REITs an even more compelling investment option. Now, when it comes to REIT investing, you've got a big decision to make. Do you go global or stick closer to home with UK-focused REITs? It's like choosing between a diverse international buffet or a hearty, home-cooked meal. Both can be incredibly satisfying, but it all depends on your taste and investment goals. Global REITs offer exposure to a wider range of economies and real estate markets. This diversification can help cushion your portfolio against regional downturns. Imagine owning a piece of a skyscraper in New York City, a shopping mall in Tokyo, and a logistics warehouse in London. Talk about spreading your risk. On the other hand, UK REITs provide a more focused approach, allowing you to capitalize on the specific dynamics of the UK real estate market. You're essentially betting on the long-term growth and stability of the UK economy. The key is to find the right balance. Diversifying across both global and UK REITs can provide a well-rounded approach, mitigating risk while maximizing your potential for return. Now, let's talk sectors. Not all real estate is created equal, and some sectors are poised for explosive growth in the coming years. Remember, identifying these trends is like catching the next big wave in surfing. It can make all the difference. Take logistics and industrial real estate, for example. With the relentless rise of e-commerce, the demand for warehouses and distribution centers has skyrocketed. Companies like Amazon are gobbling up these spaces faster than you can say 2-day shipping. Then you have telecommunications infrastructure. As 5G and other next-generation technologies roll out, the need for cell towers, data centers, and fiber optic cables is exploding. These REITs are like the picks and shovels during a gold rush. They provide the essential infrastructure for the digital age. And let's not forget about residential real estate. People will always need a place to live, and certain markets, like the Sunbelt region in the US, are experiencing population booms. REITs focused on these high-demand areas are well-positioned for steady growth. Now, while a juicy dividend yield might catch your eye, it's crucial to look beyond the surface when evaluating REITs. Remember, a high yield doesn't always tell the whole story. It's like judging a book by its cover. You need to dig deeper. One crucial factor is the potential for dividend growth. A REIT that consistently increases its dividend payments over time is a sign of a healthy and growing business. It's like compound interest on steroids. Those dividend increases can really add up over the long haul. Another key aspect is the quality of management. Just like any other business, a well-managed REIT with a clear strategy and a track record of success is more likely to deliver strong returns for investors. And let's not forget about financial metrics. Keep an eye on things like debt levels, occupancy rates, and funds from operations, FFO. These numbers provide valuable insights into the financial health and stability of a REIT. All right, let's dive into some of the top global REITs that I've got my eye on. First up is Prologis, ticker symbol PLD. Now, if you're buying stuff online, chances are it's passed through a Prologis warehouse. They're the largest owner of logistics and industrial properties worldwide. Think massive warehouses and distribution centers that keep the e-commerce world spinning. And with online shopping only getting bigger, Prologis is in a prime position to profit. They've got a global footprint, with properties in key markets like the US, Europe, and Asia. This diversification is key. It means they're not reliant on any single economy, which adds a layer of safety to your investment. Plus, their size gives them massive negotiating power with tenants, which translates into stronger rental income and ultimately better returns for investors like you and me. Now, remember, I'm not a financial advisor. This isn't financial advice, just my own research and opinion. But when I see a company strategically positioned in a booming sector with a global reach, it definitely catches my attention. Next on the list is American Tower Corporation, AMT. These guys are all about telecommunications infrastructure, specifically cell towers. You know those metal structures you see everywhere? Yeah, those are cash cows. In today's world, data is king. We're constantly on our phones, streaming, browsing, working, and American Tower provides the infrastructure that makes it all possible. They operate in over 20 countries, giving them a massive global network and a piece of the action in some of the fastest-growing mobile markets. And here's the kicker. As we move towards 5G and beyond, the demand for data is only going to explode. This puts American Tower in the sweet spot to capitalize on that growth. They can lease space on their existing towers to multiple carriers, creating a steady stream of cash flow. Remember, folks, real estate isn't just about apartments and office buildings. Investing in the infrastructure that powers our digital lives is a smart move, and American Tower is leading the charge. Let's shift gears now to residential real estate with Mid-America Apartment Communities, or MAA. They're laser-focused on high-demand areas, specifically the Sunbelt region of the US. Think Florida, Texas, Arizona. Now, these areas have been seeing massive population growth, and that translates into more people needing places to live. MAA develops and manages apartment communities in these booming markets, catering to young professionals and families who are drawn to the lower cost of living and job opportunities. And here's the thing, as more people flock to the Sunbelt, the demand for quality housing continues to rise, driving up rental rates and occupancy for MAA. This consistent demand creates a stable income stream, making it a potentially attractive option for long-term investors. The key takeaway here is that demographics are destiny. By focusing on regions with strong population growth, MAA is positioning itself for continued success. Moving on, we've got Iron Mountain, ticker symbol IRM. Now this one's a bit different. They're not your typical real estate play. Iron Mountain specializes in data storage and information management. Think about all the data companies generate and need to store securely. Medical records, financial documents, even those embarrassing childhood photos you thought were gone forever. Iron Mountain provides the physical space and security to protect it all. They've been around for decades, and their business model has evolved with the times. As the world goes increasingly digital, the need for secure data storage is only going to skyrocket. This puts Iron Mountain in a unique position to capitalize on the digital transformation. And here's the beauty of it. Data storage is a necessity, not a luxury. Businesses can't afford to lose their data, making Iron Mountain services essential and their revenue streams more predictable. Last but not least, we've got Life Storage, LSI. This REIT focuses on a sector that tends to do well even when the economy takes a hit, self-storage. Think about it. When times are tough, people downsize, move, or just need extra space. And that's where Life Storage comes in. They provide convenient and affordable storage solutions, catering to both individuals and businesses. Now, self-storage might not be the sexiest investment, but it can be a solid performer. It's a needs-based business with consistent demand. Plus, Life Storage has a strong track record of growth and dividend payments, which can provide some stability to your portfolio. Remember, a well-diversified portfolio includes assets that perform differently in various economic conditions. Life Storage's recession-resistant nature could make it a valuable addition to your REIT holdings. Now, let's hop across the pond and talk about some top UK REITs that are killing it. First up, we've got Segro, ticker symbol SGRO. These guys are like the Prologis of the UK, dominating the logistics and industrial property market. They own and develop warehouses, distribution centres, and industrial estates in prime locations across the UK, catering to the booming e-commerce industry. Just like their global counterparts, Segro is riding the wave of online shopping and the increasing demand for fast and efficient delivery networks. But here's what sets Segro apart. They focus on high-demand urban areas, where land is scarce and rents are higher. This strategic positioning allows them to command premium prices and secure long-term leases with major players in e-commerce and logistics. Now, the UK market might be smaller than the US, but don't underestimate the power of a dominant player in a growing sector. Segro's strategic focus and strong market position make them a compelling option for investors seeking exposure to the UK real estate market. Next up, we've got Tritax Big Box REIT, ticker symbol BBOX. As their name suggests, they specialize in big box logistics facilities. These are those massive warehouses you see near highways, often leased to major retailers like Amazon and Tesco. Tritax focuses on securing long-term leases with these blue-chip clients, which provides a stable and predictable income stream. We're talking about leases that can span 15 to 20 years, locking in those rental payments and providing peace of mind for investors. And here's another key point. The growth of online retail is a global phenomenon. As more people shop online, the demand for these large-scale logistics hubs will only increase. This puts Tritax in a strong position to benefit from the continued growth of e-commerce, both in the UK and internationally. Remember guys, investing in real estate is about identifying long-term trends. Tritax's focus on a sector with sustained demand makes it an interesting prospect for investors seeking stable income and potential capital appreciation. Last but not least, let's talk about Primary Health Properties, PHP. This UK REIT focuses on a sector that's known for its resilience, even in uncertain times: healthcare. They own and lease purpose-built primary healthcare facilities across the UK and Ireland. Think GP surgeries, clinics, and pharmacies. These are essential services that people need, regardless of the economic climate, making PHP a potentially defensive play in your portfolio. But here's the real kicker. A significant portion of their rental income is backed by the government. This means that even if a tenant faces financial difficulties, the rent is still paid, providing an added layer of security for investors. Plus, the healthcare sector is only growing. As the population ages, the demand for healthcare services will continue to rise, creating a favorable backdrop for PHP's long-term growth. So, we've covered some top global and UK REITs, but which ones come out on top? Well, it all depends on your investment goals and risk tolerance. Let's start with dividend yields. Generally, UK REITs tend to offer juicier yields compared to their global counterparts. This is partly due to differences in tax structures and market dynamics. So, if you're looking for that immediate cash flow, UK REITs might seem more appealing. However, remember that higher yields don't always equal better investments. You also need to consider the potential for dividend growth. Global REITs, particularly those in growth sectors like logistics and data centers, might have more room to increase their dividends over time as their businesses expand. It's a classic trade-off: higher current income versus potential for future growth. Now, let's talk about total return potential, which includes both dividend payments and changes in the REIT's share price. Global REITs, with their exposure to faster-growing economies and sectors, might offer greater potential for capital appreciation. Think about it. Companies like Prologis and American Tower operate in global markets with massive growth opportunities. As their businesses expand, their earnings and share prices could potentially follow suit. On the other hand, UK REITs, particularly those with government-backed leases or exposure to essential sectors like healthcare, might offer more stability and lower volatility. The key takeaway here is that there's no one-size-fits-all answer. It's about finding the right balance between growth and stability that aligns with your investment goals and risk tolerance. Instead of viewing this as an either-or situation, consider the power of diversification. By combining both global and UK REITs in your portfolio, you can potentially enjoy the best of both worlds. You can benefit from the higher yields of UK REITs while also tapping into the growth potential of global players. Plus, diversification across different geographic regions and sectors can help mitigate risk and potentially enhance your overall returns. Remember, don't put all your eggs in one basket, especially when it comes to real estate. A well-diversified approach is key to navigating the ever-changing real estate market and potentially achieving your long-term investment goals. Alright, so you're convinced about the potential of REITs, but you're probably wondering, how do I actually invest in these things? Well, you've got two main options. You can buy individual REITs or you can invest in REIT ETFs. Buying individual REITs is like picking stocks. You're putting all your eggs in one basket. You've got to do your research and analyze the company. It's more hands-on, but if you prefer simplicity, then REIT ETFs are the way to go. ETFs are baskets of stocks that offer instant diversification. You're spreading your risk across a portfolio. Plus, they're easy to buy and sell. Now, when it comes to choosing REIT ETFs, you've got a ton of options. But some of the most popular and well-regarded ones include the Real Estate Select Sector SPDR Fund, that's XLRE, and the Vanguard Real Estate ETF, that's VNQ. These ETFs hold a diversified portfolio of REITs across different sectors, so you're getting broad exposure to the real estate market. They also have relatively low expense ratios, meaning you're not losing a huge chunk of your returns to fees. Another option is to look for ETFs that specifically target the sectors we've talked about. For example, if you're bullish on logistics, you could invest in a specialized ETF that focuses solely on industrial REITs. But remember, always do your own research before investing in any ETF. Make sure the holdings align with your investment goals and risk tolerance. Look at things like the expense ratio, the trading volume, and the past performance of the ETF. Now, let's talk taxes. Unfortunately, it's not the most exciting topic, but it's important. The tax implications of investing in REITs can vary depending on whether you're investing in UK REITs or global REITs, and even where you live. Generally, dividends from UK REITs are treated as property income, while dividends from global REITs might be subject to withholding tax. It's always a good idea to consult with a tax professional to understand the specific implications for your situation. But the bottom line is, investing in REITs can be a smart way to add diversification and potential income to your portfolio. Whether you choose to invest in individual REITs or ETFs, make sure you do your research, understand the risks, and invest for the long term. Remember, this is not financial advice, it's just my perspective. Always do your own research and consult with a financial advisor to make the best decisions for your personal financial situation. Alright guys, we've covered a lot today about REITs and top picks for 2024. Remember, giants like Prologis dominate the industrial space, and American Tower leads in telecommunications infrastructure. In the UK, Segro and Tritax BBOX are key players. Specialized REITs like primary health properties offer stability. Diversification is key. Spread your investments across different REITs and sectors. Global diversification can mitigate risks and enhance returns. Look, I'm all about building long-term wealth, and REITs can be a valuable tool. They offer diversification beyond traditional stocks and bonds. Plus, the potential for passive income through dividends? That's something I'm always on board with. But remember, REITs come with risks. Do your due diligence and understand the company's financials. Stay informed and adapt your strategy accordingly. Always consult with a qualified financial advisor. If you're serious about adding REITs to your portfolio, there are a few things you can do right now to get started. First, take a look at the REITs we've discussed today. Dive deeper into their financials, understand their business models, and see if they align with your investment strategy. Next, explore different REIT ETFs. These can be a great option for instant diversification giving you exposure to a basket of REITs with just one investment. It's a convenient and cost-effective way to gain broad exposure to the real estate market. And remember, knowledge is power. The more you learn about REITs, the better equipped you'll be to make informed investment decisions. There are tons of resources available online, from financial websites to educational platforms. Take advantage of them. Now, I'm curious to hear from you. What are your thoughts on REITs? Are there any other REITs you're interested in? Drop a comment below and let's keep this conversation going. And that's it for today's deep dive into the world of REITs. I hope you found this video informative and helpful in your quest for building long-term wealth. Remember, investing in REITs can be a great way to diversify your portfolio, potentially generate passive income, and gain exposure to the real estate market. But as with all investments, it's essential to do your research, understand the risks, and make informed decisions based on your individual financial goals. Always consult with a qualified financial advisor for personalized guidance. Thanks for watching, and don't forget to like, subscribe, and hit that notification bell so you don't miss out on future videos. Until next time, take care and happy investing. Outro screen with links to other videos, social media, and website. Music continues in the background.